What is going on, guys? My name is Reda, and today's video is going to be super short and simple because I've been getting a lot of the same question, and I decided I would drop in and answer this right now. So everybody's asking me, Reda, I keep losing because of the market makers. The market makers are hitting my stop losses. How am I supposed to win against the market makers? The infamous market maker is stealing my money. This makes absolutely zero sense. No, there is no such thing as a market maker coming out and screwing you out of your $200 on Robinhood. It's simply not the case, right? There's so much misinformation being spread around market makers that I've decided to drop in and make a video explaining exactly what market makers are. So let's change the term up a little bit to make this a bit easier to understand. Let's think of a market maker as a liquidity provider. So what does that word mean, liquidity? Here, thrown around often because us finance guys, we like to make big words for really simple concepts. That way it looks like we're doing something that's way bigger than it actually is. But liquidity, think about it as a big jug of water, right? If the water's filled all the way to the brim, as soon as you tip it over, the water's gonna start flowing. It's gonna be very fluid, okay? If the same jug has a little bit of water and you tip it, it's gonna take way longer before the water starts coming out, right? So if a stock is liquid, that means that there's so many people there's a lot of volume that you're able to get in and out quickly. If a stock is illiquid, right, not liquid, that means that there's not a lot of volume, and if you buy it, you're gonna get stuck, okay? Now, this is especially interesting when it comes to options. Remember, there's always a bid and an ask to everything that you're purchasing, right? It's even up here on Thinkorswim, right? A lot of people just look at this price. Look at this right here, bid, ask, okay? Because the market's closed, it's a bit wider than it be, but let's say you're going and you buy at $5, okay? So you buy at $5. And let's say the ask is at $6. That means you can buy at 5 and sell at 6 and you've captured $1, right? That's the bid and ask spread, right? All a market maker is trying to do, the whole market maker's job is like, a lot of people ask me, Reda, how does Robinhood still make money even though rates are so low? Well, there's only two ways Robinhood makes money. A, they make money on giving you margin, right? But if the rates are low, how else can they make money? Well, they can get super special fills. Not like it's not possible, but they can buy it at a certain price and sell it to you and capture 2 cents. You and I, we don't give a shit about 2 cents. But Robinhood, 2 cents, right? If they do that for 1,000 contracts, they're making money, right? They're making 2,000 cents, bang out free. So here's the key word here in this whole situation. So a market maker is trying to provide liquidity. They're trying to make the markets easier to go. They're trying to make them easier to flow. But Reda, what incentive do they have to make the markets easier to flow, to make it easier for me to get it in and out? Well, the only incentive is that they get to make guaranteed money, right? They get to make money on the bid and ask spread. So if there's a 5-cent spread, they're making guaranteed 5 cents. Now, what does this mean? It means that they're not allowed to speculate if something is going up or down. So how does this affect the stock price? Think about this, okay? The market maker wants to stay neutral delta. What the hell does neutral delta mean? Neutral delta means that no matter where the stock goes, they made money, okay? Long delta, short delta, we understand that. It's another fancy word, but for the main part, a market maker wants to stay neutral. They don't want to be short, they don't want to be long because, short, long, right? They don't want to be speculating on direction. They just want to make money on that spread. So they come in and they sell it to you for a certain price. They buy it for a certain price. They sell it to you for a certain price. They made guaranteed 5 cents. Now, what does this even matter? Why does this even matter? Well, because if a market maker, let's say, for example, I want to go buy 1,000 contracts of stock ABC, and that stock typically only trades 10 contracts. 1,000 is way more, 100 times more than the average volume. So it's not going to get filled. So I have to go in and I have to bid for an attractive price, right? I have to bid a little bit higher. I got to make myself like, yeah, please give me money, right? So the market maker who's running that ticker or whatever, he's like, hey, this guy wants 1,000 contracts, right? And there's not that much volume. But if I go in and fill him, because there's not that much volume and the spread is a little bit wide, I'll make guaranteed 10 cents for every contract that I sell him. So they go in and I'm trying to bid, I'm trying to buy. They sell me 1,000 calls. They sell me 1,000 call contracts. So when you sell a call, what happens? So when you sell a call, what happens? You're short. So the market maker wants to stay neutral. They can't be going up or they can't be going short or long. So now they're short, right? So the market maker is now short because they sold me 1,000 calls. So I'm all happy. I'm all filled. Forget about me now. Right now we're talking about the market maker. They're negative 1,000 calls, right? How are they going to they can't go buy 1,000 calls, right, on the opposite end or buy puts because that would skew the volume more. Another market maker would have to come fill them. So what do? They go to the underlying stock. So they go to ABC and they're like, I want to buy they want to buy a proportional amount of shares. So when you buy shares, you're long, correct? So now they own the shares and they're short the calls. right? They become one, man. They're proportional. The same amount of shares that they own will affect. So if the stock price goes up, the shares will go up, and the calls will the short will go down, but they'll go up proportional to how much they went down. So they'll be even. So they're neutral delta. So the only money that they made was making money, that guaranteed money on that spread. And if they're doing that 1,000 times a day, you know, it's kind of like that one movie where the guy just stole a penny from every single person. They're making a ton of cash, right? That's all a market maker is doing. They're trying to make money on the spread, and they want to stay neutral delta. Now, I've been loving the feedback recently, so if this video gets 5 likes, I'll show you how to do this, how to look for abnormal volume. So you might be saying, right, I always see these huge options trades come in, especially on options floor or whatever. How the hell am I supposed to know if somebody's buying or shorting? Because, you know, there's 2 sides to every transaction. Well, if they sold calls, so if I go to buy an abnormal amount of calls and the market maker sold calls and then they had to go buy the stock, at the same time they sold me those calls, right? So at the same time they went short and they went to go buy those shares to go long, that way they can be even, the stock price pumps because they're also buying an abnormal amount of shares. So if you notice, like, hey, this guy got filled and the stock price pumped, well, that means the market maker is the one who sold them because he had to buy them so he could stay neutral. That means the guy who's making the original play, he's the one who bought them, correct? So the guy who's making the original play, the guy you're trying to follow, is long, right? So the play is a long play. The market maker's out, he's done, he doesn't care anymore. But that guy who sold them, he's on the hook all the way until expiration. So that's the guy that you're watching, right? The market maker, as soon as they buy their shares and they sell their contracts, or they buy their contracts and sell their shares, or borrow, so sometimes they have to borrow the shares because they don't own them, right? So they go borrow the shares and then they sell them, right? So if I go in and I want to sell 1,000 call contracts, the market maker comes and fills me. Now he's long. So what does he do to break that long? He goes and sells shares, right? So now they're even. So when he sells shares, the stock price dumps. When he buys shares, the stock price pumps. I'm sorry, but if you're seeing, hey, this guy got filled and then the stock price pumped, that means the market maker's out. He's done, right? The stock price pumped. They sold the contracts. They're even. That means the only thing that matters now is Reda still owns 1,000 contracts that expire in 2 weeks, right? He thinks, and they're out of the money. So we're probably likely going to go in the money, because if that guy's making a crazy abnormal bet that this is going to happen, then it's very, 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 very likely that guy is going to make you some cash. So 5 likes, I'll drop a video on how to actually analyze options volume this Wednesday, and I'll show you hopefully a live example if I can find a nice one, right? I'll show you how you can look for abnormal options volume that will tell you where the stock price is going to go in the future. So how you can look what the large money is trying to do. Besides that, that's all a market maker's doing. They're not trying to screw you out of your 200 bucks. They're just trying to get to neutral delta and capture the spread and provide liquidity up and down. That's it. That's all that's going on. So if you have any questions, please do yourself a favor, or actually do me a favor. I would actually love to answer your questions. Drop a comment down below. If you enjoy the video, obviously like and subscribe, and I'm very excited to see you guys in the next one.